Welcome to The Explainer. Today, we are digging into some huge new rules from the Reserve Bank of India that are shaking up the stock market. This is really a story about a big choice: speed and risk versus slow and steady stability.
And the market, well, it reacted instantly. The moment the news about the RBI's plans hit the wire on February 16th, it sent a massive shockwave. Shares of big-name brokers and even the stock exchanges themselves just tumbled. Some dropped as much as 10% in one day, all based on this one announcement.
So, a dive like that, it just leaves you with one big question, right? What on earth did the central bank say that could spook the market so badly? Okay, let's get right into it.
Here's how we're going to break it down. We'll start with that initial market shock. Then we'll try to understand why the RBI is making this move. After that, we'll get into the nitty-gritty of the new rulebook, figure out who wins and who loses, and finally, we'll zoom out to see the big picture.
So, this all kicked off when the RBI put out a new directive. Now, the official name is a mouthful: Commercial Banks Credit Facilities Amendment Directions. I know, it sounds pretty dry, but these rules, which are set to take effect in 2026, are going to completely rewrite the playbook for how banks lend money to stockbrokers. So you have to ask, why the big shakeup, and why now? Well, the main goal here is crystal clear. The RBI wants to build a stronger wall between the everyday ups and downs of the stock market and the country's core banking system.
And look, you don't have to take my word for it. This is straight from the source. The central bank is literally trying to build a firewall. The whole idea is to make sure that a really bad day on the stock exchange doesn't spill over and cause a crisis for the banks that we all depend on.
Now this is where it gets really interesting, because this represents a complete change in philosophy. We are moving away from a system where a person's reputation or a company's guarantee was good enough to a system where the only thing that matters is cold, hard assets. It's not about who you are anymore, it's about what you have to back it up. Okay, let's get into the specifics then. What exactly are these new rules that brokers will have to live by? This is where the rubber really meets the road. So, the first number you need to burn into your memory is this one: 100%. From April 1st, 2026, every single loan a bank gives to a broker has to be 100% secured by actual collateral. The days of getting by on a promise are officially over. And that brings us to our second key number: 40%. This one's a little more complex. See, when a broker uses stocks as collateral, banks now have to apply a minimum haircut of 40%. So, what in the world does that mean? A haircut is just a fancy term for a safety cushion. It's the bank protecting itself in case the value of the collateral, the stocks, suddenly drops. So for every 100 rupees worth of stock a broker puts up, the bank will only lend them 60 rupees against it. Simple as that.
And this table here, it just lays out the new reality. You can see right there, the loan-to-value for stocks is capped at 60%. That's our 40% haircut in action. But notice how you can borrow more against safer things like debt mutual funds. They've also put some pretty firm caps on how much individuals can borrow, too.
Now this is a huge deal. The RBI is flat out banning banks from funding what's called proprietary trading. These are the trading desks inside brokerages that use the firm's own money to make big speculative bets. The RBI is basically saying, hey, you can gamble with your own money, but you can't do it with capital that's connected to our banking system. So with all these tough new rules coming down the pipe, who gets hurt the most? And is anybody actually coming out ahead? Because a change this big, it creates ripples that spread across the entire market.
And it's not just one group. This touches everyone, from the high-stakes prop traders to the everyday brokers we use to the stock exchanges themselves. Even regular retail investors like us are going to feel the downstream effects.
But yeah, if there's one group that's really in the hot seat, it's the proprietary traders. These are the guys who often used a ton of borrowed money from banks to make their trades bigger. With that main funding pipeline now completely shut off, they have to go back to the drawing board and figure out a whole new way to operate. No, for the brokers that most of us deal with, it's a bit different. It's less of a crisis and more of a massive headache. They're suddenly facing much higher costs because they have to tie up more of their own cash or assets as collateral. This capital blockage, as some are calling it, could really squeeze their profits.
All right, so let's zoom out for a minute. What's the grand plan here? What is the RBI really trying to accomplish by putting all this pressure on the brokerage industry?
This timeline kind of puts it all into perspective. The announcement on February 14th was the starting gun.
The market reacted immediately, and now the entire industry is in a race against the clock to get ready for April 1st, 2026. That's the day everything changes for good.
So when you boil it all down, here's what it comes to. The RBI is making a very deliberate trade-off. They know they're making it more expensive and more difficult for stockbrokers to do business, but in exchange for that pain, they get something they value a lot more, a safer, more stable financial system that's less likely to blow up. And that, of course, leaves us with the million-dollar question for the future, doesn't it? Have they found the right balance? Are these tough rules just the price we have to pay for a stronger market in the long run? Or are we accidentally killing off the very risk-taking and energy that makes a market grow? Honestly, only time is going to tell.
Hey, if this breakdown helped you make sense of what's happening in the markets, do me a favor and hit that like button. Share this with anyone else who might find it useful, and of course, subscribe for more explainers on the big topics shaping our world.
And we really want to hear from you. What do you think about these new RBI rules? And what's another complex topic you'd like us to tackle next? Drop your thoughts in the comments below.